Welcome back, everyone. John Smith here, and today we're going to talk about something that I think is genuinely being overlooked right now, not just by retail investors, but honestly by a lot of financial media as well. We've got two very different stories unfolding at the same time, and on the surface they look like they have nothing to do with each other. One is a diplomatic story, the US and Iran working towards some kind of new nuclear framework deal. The other is a very technical, very specific situation happening inside the silver futures market on something called COMEX, where the cost of rolling silver contracts is spiking, and physical delivery pressure is building up fast, right before a critical date called May 27th, First Notice Day. Now here's the thing, when you look at these two stories separately, they seem totally unrelated. But when you put them together and think carefully about what each one means for the silver market specifically, you start to see a picture that most headlines are completely missing. That's what we're going to walk through today, step by step, in a way that actually makes sense even if you've never traded a futures contract in your life. Let's start with why any of this matters to you right now. Silver is not just a shiny metal. It's not just jewelry or old coins your grandmother kept in a drawer. Silver is one of the most industrially important commodities on Earth. It's used in solar panels, electric vehicles, semiconductors, medical devices, water purification, and a whole list of other things that are growing rapidly in demand. It also has a long history as a monetary metal, meaning people have treated it as a store of value for thousands of years. And right now, in 2026, we're at a moment where the financial side of silver and the physical, real-world side of silver are starting to pull in very different directions. That tension is what this whole video is about. And the timing of what's happening with a US-Iran deal potentially reshaping energy markets right as the COMEX silver market hits a critical pressure point makes this one of the more interesting convergences I've seen in a while. So let's break this down properly. First, let's talk about COMEX, because if you're not familiar with how silver futures work, some of this won't quite land. COMEX is short for Commodity Exchange. It's the primary exchange in the United States where futures contracts for silver and gold, copper, and other metals are traded. A futures contract is essentially an agreement to buy or sell a specific amount of a commodity at a specific price on a specific future date. Most people who trade these contracts, we're talking about hedge funds, banks, trading desks, speculative investors, never actually intend to take physical delivery of the metal. They're using the contract as a financial tool. They're betting on price direction. They buy and sell these contracts back and forth, and at the end of the day, they just settle the difference in cash. Nobody actually shows up with a truck to pick up 5,000 ounces of silver. That's the standard assumption. That's how the system normally works. But here's where it gets interesting. There are always a small number of participants who do want the real metal. And every futures contract has what's called an expiration date. When a contract gets close to expiration, if you still hold it and you don't want to take delivery, you have to roll it, meaning you close your current contract and open a new one for a future month. This rolling process has a cost, and that cost is reflected in what's called the spread between the front month contract and the next month contract. Under normal conditions, silver futures trade in what's called contango, meaning future months are priced slightly higher than the current month, which reflects things like storage costs and financing. The roll cost is usually manageable. It's just part of doing business in the futures market. Now here's what's been happening. The cost of rolling silver futures contracts, particularly rolling from the May contract into June or July, has been rising in a way that's catching attention. And this matters because when the cost to roll becomes elevated, it creates a very specific kind of pressure. Traders and funds who are long silver, meaning they've bought contracts expecting prices to go up, start doing a calculation. They ask themselves, is it cheaper to just roll this contract again and keep my paper position, or does it actually make more sense to stand for delivery and take the physical metal? For most participants, rolling is still the default, but when roll costs get high enough, the calculus starts to shift. Some players who would normally roll start to consider delivery instead. And even a small increase in the number of participants requesting physical delivery can matter enormously, because the physical silver available in COMEX warehouses to satisfy those delivery requests is not unlimited. This is what makes First Notice Day so significant. For the May silver contract, First Notice Day falls on May 27th. This is the first day on which holders of long futures contracts can be notified that they will receive delivery of physical silver. If you're holding a long contract and you don't want to take delivery, you need to either close your position or roll it before first notice day. So the days leading up to May 27th are always a moment of decision. And when roll costs are elevated, as they are right now, the dynamics of that decision get more complicated. More holders may decide to stand for delivery rather than pay the higher cost to roll. That means more physical silver needs to actually leave COMEX vaults. And if the amount of silver being requested for delivery exceeds what's comfortably available, you get what the market calls a delivery squeeze. That's not just a technical inconvenience that can move prices in a meaningful way. Now, this has happened before in the silver market. If you remember the events of early 2021, retail investors on social media tried to squeeze the silver market by pushing people to buy physical silver and silver ETFs. The attempt didn't fully work the way organizers hoped, but it did put enormous stress on physical silver premiums and delivery timelines. What we're talking about today is different. It's more structural, more rooted in the mechanics of the futures market itself, and potentially more significant because it's driven by institutional dynamics rather than a coordinated retail campaign. Think about it this way. When the pressure comes from inside the plumbing of the financial system, it tends to be harder to dismiss and harder to paper over quickly. So that's side one of this story, the COMEX situation. Now let's talk about the U.S.-Iran diplomatic framework, and then we'll connect these two stories in a way that I think will genuinely surprise you. The United States and Iran have been engaged in a new round of nuclear negotiations, building on the long history of diplomatic back and forth that goes back to the original JCPOA, the Joint Comprehensive Plan of Action, that was signed in 2015, then abandoned in 2018, and has been the subject of attempted revivals ever since. In 2026, there is a new framework being discussed that would involve Iran limiting its nuclear enrichment activities in exchange for phased relief from economic sanctions. And if that deal goes through, even partially, it has significant implications for global energy markets, because Iran is sitting on enormous oil reserves that are currently locked out of global markets by those sanctions. Here's what most financial coverage focuses on when they talk about a potential U.S.-Iran deal: oil. And understandably so. Iran has the capacity to add significant barrels to global oil supply if sanctions are eased. That would put downward pressure on oil prices. Lower oil prices mean lower transportation costs, lower input costs for manufacturing, and generally lower inflationary pressure across the economy. The mainstream financial media talks about this deal almost entirely through the lens of crude oil, what it means for energy prices, what it means for OPEC dynamics, what it means for gas at the pump. And that coverage is not wrong, it's just incomplete. What almost nobody is talking about is what a U.S.-Iran diplomatic breakthrough, or even just the expectation of one, does to the broader risk environment and specifically to the dollar. Let's unpack this carefully. When geopolitical tensions de-escalate, there's a general tendency in financial markets for the U.S. dollar to soften slightly. The dollar tends to benefit from global uncertainty. It's the world's reserve currency, it's seen as a safe haven, and when the world feels scary or unpredictable, money flows into dollar-denominated assets. When tensions ease, some of that safe haven demand fades, and a softer dollar, even a marginally softer one, is historically positive for commodities priced in dollars, including silver. This is a well-established relationship. When the dollar weakens, the price of silver in dollar terms tends to rise, because the same ounce of silver now costs more dollars to buy. So a diplomatic breakthrough with Iran could contribute to a softer dollar environment, which would provide a fundamental tailwind for silver prices at exactly the same time that the COMEX physical delivery pressure is building. But there's actually a second layer to this that goes even deeper, and this is where it gets really interesting. Iran, under sanctions, has been largely cut off from the global dollar financial system. When countries operate outside the dollar system, whether by necessity or by choice, they often look for alternative stores of value and alternative means of settling trade. Gold and silver have historically played this role. There is a long documented history of sanctioned economies increasing their use of precious metals as a parallel financial system. Iran is not a small economy. It's a major regional power with significant trade relationships, particularly with China, Russia, and parts of the Middle East and South Asia. The anticipation of sanctions relief, combined with potential normalization of Iranian trade flows, creates some very interesting dynamics, in how physical precious metals might circulate in global markets. This is analytical territory worth considering. It adds another dimension to why physical demand for silver could be under upward pressure right now. And here's another angle that almost no one in mainstream financial media is connecting. Iran has silver mining capacity that operates largely outside global markets under sanctions. If a diplomatic deal proceeds and Iranian economic activity begins to normalize, Iranian silver production and trade could eventually find its way back into global market channels. Now that might seem like it would increase supply and therefore be a negative for silver prices. But the timing matters enormously. In the short term, meaning the weeks and months immediately following any deal announcement, what you'd actually see is increased investment demand for silver, driven by the improved risk sentiment and the dollar dynamics we just talked about. The potential supply normalization from Iranian production would take much longer to materialize. So in the near term, the deal is likely to be a net positive for silver prices, not negative. That's a nuance that gets completely lost in the standard oil-focused coverage. If you've found this breakdown useful so far, this would be a great moment to hit that like button. It genuinely helps this channel reach more people who are trying to make sense of what's happening in these markets. And if you're not subscribed yet, the subscribe button is right there. We cover these kinds of layered market stories regularly, and I think you'll find it worth your time. Let's keep going, because we're just getting to the part where these two stories really collide. Let's zoom back in on COMEX and think about what the institutional players, the big funds and trading desks, are actually seeing right now. They're watching a situation where roll costs are elevated, first notice day is approaching fast, and the macro backdrop is shifting in a way that could support silver prices. Now think about what a large fund manager does in this situation. If you're running a fund with a significant silver position, you have a few choices. You can roll your contract at the current elevated cost and hope that prices move in your favor enough to justify that cost. You can close your position entirely and step aside. Or, and this is the option that creates the most stress in the physical market, you can stand for delivery. Taking physical delivery of silver is not a casual decision for a large fund. It requires storage arrangements, insurance, and logistical infrastructure. But it becomes more attractive the higher the roll cost gets, and it becomes more strategically interesting if you believe silver prices are about to move significantly higher. Now here's something important to understand about how COMEX warehouses actually work, because this is where the concept of a delivery crisis starts to make sense. COMEX publishes daily reports on the silver held in its registered and eligible vaults. Registered silver is metal that has been specifically prepared and certified for delivery against a futures contract. Eligible silver is metal that meets COMEX quality standards and is stored in COMEX vaults, but hasn't been formally registered for delivery. The total silver in these vaults sounds like a lot. We're talking hundreds of millions of ounces. But the registered silver, the stuff that can actually be delivered against contracts right now, is often a much smaller number. And the ratio of open interest in silver futures contracts to the amount of registered silver available for delivery is one of the most closely watched numbers in the precious metals market. When that ratio gets stretched, when there are a lot more paper claims on silver than there is silver available to fulfill those claims physically, the system becomes vulnerable to exactly the kind of stress we're describing. Here's an analogy that might help. Imagine a bank where total deposits are $1 billion, but the bank only keeps $50 million in cash on hand at any given time because normally only a small percentage of depositors want to withdraw cash on any given day. That works fine under normal conditions. But if something happens that causes a significant number of depositors to all want their cash at the same time, what do you get? A bank run. The COMEX silver situation isn't a bank run, but the structural logic is similar. The system works smoothly when most participants roll and don't take delivery. It comes under stress when the proportion wanting actual physical metal increases. And right now, multiple factors, elevated roll costs, macro uncertainty, geopolitical shifts, strong industrial demand, are all pushing in the direction of more physical demand, not less. Now let's talk about what this actually means for silver prices, because that's ultimately what most people watching this video care about. When physical delivery pressure builds on COMEX, it doesn't always lead to dramatic sudden price spikes. Sometimes it does, but more often the pressure manifests in more subtle ways first. You might see the spread between spot silver prices and futures contract prices tighten, or even flip into what's called backwardation, where the near-term contract is priced higher than future months, the opposite of the normal contango structure. You might see premiums on physical silver products, coins, bars, rounds, rise faster than the spot price as dealers anticipate supply constraints. You might see unusual trading activity in the days right around first notice day as funds scramble to either roll or close positions. All of these are signals worth watching closely right now. What's particularly interesting about the current moment is the timing of the U.S.-Iran diplomatic story relative to the May 27th first notice day. These two things are happening at the same time, not because anyone engineered it that way, but just because that's how markets work. Multiple stories, multiple forces, multiple timelines all converge at once. The diplomatic negotiations have been ongoing for months, and they're now at a point where a framework is being discussed seriously. The COMEX May contract has been heading toward its expiration on its own calendar. The fact that these two things are colliding right now, in late May of 2026, is what makes this moment analytically interesting. It's not a conspiracy, it's convergence. And convergence is often where the most significant market moves originate. Think about it this way. A single factor pushing in one direction rarely moves a market dramatically. But when you have 3, 4, 5 factors all pointing the same way at the same time, that's when you get real momentum. Right now in silver, you have elevated roll costs making delivery more attractive. You have first notice day approaching and creating a natural deadline. You have macro conditions, potentially softening dollar, geopolitical de-escalation, supporting precious metals fundamentally. You have strong underlying industrial demand for silver, driven by the green energy transition, particularly solar panels and electric vehicles. And you have a global environment where more investors are thinking seriously about tangible assets as a hedge against financial uncertainty. Each of these factors on its own is interesting. Together, they're potentially meaningful in a way that deserves serious attention. Now, I want to be clear about something important, and I want to be honest with you here, because this channel is built on straightforward analysis, not hype. None of what I've described today guarantees a silver price move. Markets are complex, and they surprise everyone, including experienced analysts, on a regular basis. The COMEX delivery pressure could resolve without drama if enough participants simply roll their contracts. The U.S.-Iran diplomatic framework could stall or fall apart, as these negotiations often do. The dollar might strengthen rather than weaken. Industrial demand could soften unexpectedly. I'm laying out a framework for thinking about what's happening and why it matters. I'm not telling you what silver is going to do because nobody can tell you that with certainty. What I'm telling you is that the setup is more interesting and more complex than most mainstream financial coverage is suggesting, and that's worth understanding regardless of what you decide to do with the information. There's also something worth acknowledging on the other side of this equation. If a U.S.-Iran deal does move forward and oil prices decline significantly, that could have deflationary effects on the economy. Deflation, or even a significant reduction in inflationary pressure, can actually be negative for silver in some scenarios because part of silver's appeal is as an inflation hedge. If inflation concerns fade, some of the investment demand for silver could fade with it. This is one reason why the silver market is more complex than the simple narrative of geopolitical uncertainty is good for silver. Different macro scenarios affect silver in different ways, and you have to think through the whole picture, not just the parts that support one conclusion. That honest acknowledgement of complexity is what separates real analysis from hype. Similarly, on the COMEX side, it's worth noting that the exchange has mechanisms to manage delivery pressure. COMEX can raise margin requirements, making it more expensive to hold contracts going into delivery. They can adjust position limits. They have tools available to reduce stress on the system. Whether those tools would be deployed and whether they'd be effective is an open question, but it's part of the complete picture to recognize that the system is not without defenses. Understanding this doesn't make the current setup less interesting. It just means you should think about the range of possible outcomes rather than assuming only one scenario can play out. The mental framework I'd suggest for keeping all of this organized in your mind is this. There are two layers to the silver market at any given time. The first layer is the paper market, the futures contracts, the ETFs, the financial instruments that reference silver prices. This layer is massive. It dwarfs the physical market in size. Most price discovery happens here. The second layer is the physical market, the actual metal that exists in vaults and warehouses and the hands of investors and industrial users. Normally, these two layers move together smoothly. When they diverge, when the paper market and the physical market start to tell different stories, that's when things get interesting and sometimes volatile. What we're watching right now is a situation where the physical layer is experiencing pressure, while the paper layer is still finding its footing. The US-Iran story and the COMEX roll cost situation are both contributing to that divergence. Keeping that framework in mind helps you make sense of why specific market dynamics matter beyond just watching the daily price move. The silver market in 2026 is also operating in a structural context that's different from any previous decade. And that's worth mentioning because it affects how you should interpret everything we've discussed. The global energy transition is creating a sustained, growing baseline of industrial silver demand that didn't exist at this scale before. Solar panel installations are consuming silver at a rate that's increasing year over year. Electric vehicle production is still adding to silver demand through its use in electronics and battery management systems. This industrial demand base creates a kind of foundation under silver that is fundamentally different from the demand dynamics of earlier eras. When you combine that structural demand story with the financial market dynamics we've been discussing, the COMEX pressure, the macro backdrop from the US-Iran negotiations, you get a market that's genuinely worth understanding carefully, even if you never touch a futures contract yourself. The media missed this story, or at least most of them did, because it requires connecting dots across multiple domains: geopolitics, futures market mechanics, currency dynamics, and commodity fundamentals. That's a lot to hold in your head at once, and most financial news cycles don't reward that kind of patient, connected analysis. They reward simple narratives. What we've tried to do today is hold more complexity than that, and show you why the complexity actually matters. Because in markets, complexity is usually where the real opportunity and the real risk both live. To bring everything together, COMEX silver is heading into a potentially stressful delivery period around May 27th, First Notice Day, driven by elevated roll costs that are making physical delivery more attractive to institutional players who would normally just roll their contracts forward. At the same time, the US-Iran diplomatic framework is creating a macro backdrop that, if it develops constructively, could soften the dollar and provide fundamental support for silver prices, even as mainstream media focuses almost entirely on that deal's implications for oil. These two stories, one technical and one fundamental, are converging at the same moment, creating a setup that's more layered and more significant than most headlines suggest. Understanding both the mechanics and the macro is what gives you a clearer picture than most people watching this space right now. And a clearer picture leads to better thinking, which leads to better decisions, and that's really what this channel is here for. Thank you for watching this all the way through. If you got something real out of this video, please leave a like. It helps the channel more than you might think, and it tells me that this kind of detailed, patient analysis is worth doing. Drop a comment below if you want me to dig deeper into any part of this, whether that's the COMEX mechanics, the Iran deal implications, or the broader silver market structure. I read every comment, and your questions often become the foundation of future videos. Subscribe if you haven't already, because we have more of this kind of work coming regularly. I'm John Smith, and I'll see you in the next one.